Hey, what's up, Dividend Growth investors? Mike Yahoo here from Dividend Stocks Rock. I hope you are doing well. Happy New Year, first video of the year, and we are starting strong with looking at three companies that should do well in 2025 and, in my opinion, are relatively undervalued. I say relatively because it's pretty hard to find something part of the S&P 500 right now that is looking great in terms of valuation, right? If you look at the Shiller PE ratio graph, you can see that now the average S&P 500 is trading almost at 38 times its earnings. It's kind of crazy. It happened only twice in the history that we have reached such a high level. In 2022, that was followed by a small bear market, and of course at the end of the tech bubble. And then after that, we were up for a major crash. Is a crash going to happen in 2025? I don't know, and honestly, I don't really care because I want to stay invested all the time because I know that for the next 10, 20, 30, 50 years, it's going to be the right choice. Maybe not in 2025, but trying to time the market, poor choices most of the time, right? So before we go in, we're going to take a quick look at my prediction in 2024. So the four stocks that I've selected last year to do well was Automatic Data Processing, Home Depot, McDonald's, and United Health Group. As you can see from this group, only ADP did well, so up 27%, while the S&P 500 total return was 28%, which is kind of crazy. Home Depot up 16, not too bad, especially considering that there's still a slowdown in construction. That did okay. For McDonald's and United Health, those are like long-term hold. Of course, it was pretty hard to average a 30% return on those, but this is what happens when you select a stock and you only have like 12 months to perform. Sometimes you're lucky, sometimes you're not, but I would have been happy with all those four selection in my portfolio. Full disclaimer, I do have ADP and I have HD as well in my portfolio. So now let's get started with another stock that did not do well in 2024. It's PepsiCo. So Pepsi, over actually the past 5 years, the stock price is only up by 9%. That's not great, of course, especially considering what happened in the S&P 500. But maybe this is the door opening for an interesting play for the years to come, because the company did not do that bad. I mean, revenue's up 35%, the earnings per share is up 32% over the past 5 years, and the company still increases dividend by 42%. So what's going wrong when you have all those great metrics, but still a company is lagging behind big time the market and other competitors? Well, the thing is, the company is facing a lot of challenges. So first, consumers are making healthier choices. They want to lose weight. They want to be in shape. And eating Doritos and drinking Pepsi is not exactly aligned with their goals. On the other side, PepsiCo has proven that they can match inflation and increase their price a lot. But at one point, we kind of feel that they hit the maximum consumers are willing to pay. We even had a pretty bad story that made the news at the beginning of 24, where Carrefour, the largest grocery stores in Europe, decided no more Pepsi products. So of course, that news made the headlines everywhere when they ended up to be just a very tough negotiation tactic. That kind of worked, but in April of 24, all products were back on the shelf. But in the meantime, it kind of struck the investors' mind that Pepsi may be struggling moving forward. We can also see with the analysis of the dividend triangle that the revenue and the earnings are slowing down with barely no growth over the past 12 months, which is a sign that we might get into another rough year in 2025. Why am I telling you that it could be an interesting pick? Well, the company still manage an amazing portfolio of brands, both on the sides of snacks and also on the sides of beverages. While the earnings per share has grown up by 32%, we have seen a PE ratio that was declining. So now it's down by 6% versus the beginning of 2020. And when you think about the major PE expansion that we have seen amongst company in the S&P 500, Pepsi seems to be lagging big time behind. So there was not added value on this one. And now you're paying a little bit smaller multiple than you were before. And another positive point was that Pepsi is now offering a higher yield, actually probably one of the highest yield that they had over the past 5 years. So that could be enough for you to be patient and get paid to wait for a little bit longer until Pepsi gets everything in order. The next one on my list, it's kind of like counterintuitive, so I will ask you to bear with me for a second, but it's MasterCard. And I know stock price is up 71% plus the dividend over the past 5 years. So you're going to tell me, but Mike, what's the point? The company seems to be rolling like there's no tomorrow. It's actually the great thing about MasterCard. The revenue's up 60% over the past 5 years. The earnings per share was really great at up 76%, and it has increased its dividend by 90%. So you're going to tell me MasterCard is a super low yield? I'll give you that. But the company almost doubled its dividend payment in only 5 years. So you can expect a lot of dividend growth coming from this one. What I like the most about MasterCard, same thing with Visa, is both companies act like toll roads. So whenever you use your credit card, MasterCard is not responsible for the debt that you're putting on that card, but they're actually making a fee on the transaction. So whenever you use the card, they're making a fee that they are charging to their merchant. And since everybody likes to pay with credit cards, they're just making more and more fees. The other growth vector that they have is more people are traveling, which includes currency fees on top of the purchases that they're making while they are traveling. So MasterCard has a very solid business model. It's kind of like a duopoly with Visa, and it's almost impossible to break, even though people are like other companies are trying to enter into that market. It's a business of scale, it's a business of size, and it's a business of network. And once you're well established, it's really hard to toss them aside. So when you look at the PE ratio and the yield, MasterCard is actually offering a lower yield, and you have to pay a little bit more in terms of PE ratio right now than you were 5 years ago. Why am I telling you that there's a deal over here? Well, the thing is, this business is growing high single digit to double digit every single quarter for the past 5 years. And actually, if you go back in time, it's actually longer than this. So an amazing growth business will require you to pay for quality. And at this point, I don't think that it's that high of a price, especially when you compare for the rest of the market. That's why I consider that MasterCard and also Visa are pretty much in the same boat here, where there still are great buying opportunities. Full disclaimer, I do have shares of Visa in my portfolio, but I do not hold MasterCard. So before we move to the third stocks that I would buy this year, I would like to invite you to download my top stocks for 2025. You're going to see some Canadian and US great opportunities. It is a smaller version of what I've done for my DSR members, but at least you can get a good 6 top picks for 2025 to start the year with a full analysis. You can go at dividendstocksrock.com/top stocks to download your booklet for free. Now, moving on to automatic data processing. It was part of my best stocks for the year last year, and for a boring company, being able to match the market, it's kind of impressive. When I look at the dividend triangle for this one, I see something amazing, which is a nearly perfect dividend triangle. The revenue is up by 31%, while the earnings per share is up by 62%. What does it tell you? Well, not only that both metrics are growing fast, but even better, ADP is able to improve its margin. What else better than finding a company that is making more and more profit on each dollar of sales, right? Well, on top of that, shareholders are being fully rewarded with a 69% dividend increase over the past 5 years. Again, full disclaimer, I do have ADP in my portfolio. It's been a little bit more than 1 year that I have it in it, and I'm quite happy with the results. The thing here is ADP is a leader in human capital management software, including payroll services. And what is great about this is it is an incredibly sticky business. In other words, well, when is the last time when you look at your pay stub that the little logo at the top of it that is making your pay stub has changed, right? Employers just don't want to spend a lot of time looking at different possibilities. When they found a business that is providing the right services at a right price, they're not just going to change anytime soon. So the thing is, it will cost them a lot of time, a lot of money just to pretty much reissue the same pay stub and deal with all the other HR laws that they have to deal with. So ADP as a really strong leadership and great relationship with several companies across the world. And the overall market is expected to grow by another 5 to 6% in 2025, according to management. Going forward, of course, you have to pay a little bit more today, so 31% in over the past 5 years, but the company's earnings has grown by 62%. So you are, yes, paying more, but for a company that has been able to improve its earnings per share by a wide margin versus what happened before in 2020. So going forward, you're paying for quality and you're also paying for stability. I'm curious to know, what are your favorite undervalued stocks for 2025? So I'm going to see you in the comment. Let me know which are the stocks that are on your buy list right now, which are that you're researching a little bit more and that you're eager to add to your portfolio. I'm going to see you in the comments, and don't forget to like and subscribe this video. Until the next one next Thursday, where we're going to look at the top stocks on the Canadian market. So stay invested.